the demand deposits are primarily savings bank account and current account. All the individuals, trusts, everybody will have the savings bank account. Even we will have a savings bank account in which your stipend is credited. So this is a savings bank account. It carries a very less interest, but you can deposit and withdraw money at any time. You have the freedom to, you can withdraw any amount, you can deposit any amount. For example, in the morning you can deposit 500, in the evening you can withdraw 300, next day morning you can withdraw 500, evening you can deposit 100. So they won't ask why are you depositing money, why are you withdrawing money. Without anybody's permission, you can at your free will, you can deposit as well as withdraw money. You can transfer money from your account, you can transfer money into your account. So this is called a savings bank account. This is primarily for non-commercial transactions. For a personal transactions, savings bank accounts are opened, and they have a very little interest. They carry around 2.5 to 4% interest. That is the normal. Some of them will be above this range, some of them will be below this range, but usually around 3 to 4% will be the savings bank interest. It will be calculated on the daily closing balance, and usually it is credited once in a quarter. So 4 times in a year you will be getting a interest on your savings bank account, but the interest rate credited is very low. This is primarily for non-commercial purpose, personal purposes. Then there is a current account. If you want to do business transactions, then you should open current accounts. All your sales amount should be credited and all your expenses should be done through the current account. So businesses will be having an account named current account. Here also you can deposit money anytime, withdraw money anytime. But one difference from the savings bank account is that these current accounts don't carry any interest at all. So even if you keep crores and crores of money in your current account, you will not get any interest, because the product is like that. You will not get any interest. And this is primarily for commercial purposes, business purposes. So these are called demand deposits because you have the absolute freedom to deposit and withdraw money at any time. Then there are time deposits. What are the time deposits? Cumulative deposits, fixed deposits, recurring deposits, all these are called time deposits. What is a cumulative deposit? If you have some 1 lakh money and you know that for the next 1 year you may not be needing this particular amount. So what you can do, there are various investment options. One of them is cumulative deposit. So you go to the bank, you ask them, I want to make a deposit for 1 year. They will say, our interest rate is, say, let us say 6% per year. So what you will do, you will give this 1 lakh transfer to the cumulative deposit. You will give an application, and in that you will mention this is a cumulative deposit for a period of 1 year, and the amount of deposit is 1 lakh. And you can give a nomination also, who will receive money in case of depositor's death. So then they will give you a deposit receipt in which they will mention 1 lakh deposit for 1 year. What is that deposit amount? What is the maturity amount you will get after a period of 1 year? So you will take this receipt. So once this amount is transferred from your savings account to deposit account, you cannot withdraw the amount from the deposits. You can withdraw the amount from savings, but you cannot withdraw the amount from the deposit. So for 1 year you have to keep the deposits with you. So this is called time deposit because you have placed this deposit with the bank for a period of 1 year. So it has a specific maturity date. It is called time deposit. In cumulative deposits, what happens is the interest is paid only at the time of maturity. Here in this case, it will be paid only after 1 year. In fixed deposit, what happens? Similarly, you deposit for 1 year, but you can specify when you want the interest back. You can take your interest on a monthly basis, in which case the interest will be deposited to your savings account on a monthly basis. We can say quarterly, we can say half yearly. So in fixed deposits, you get periodic interest. In cumulative deposits, only along with the principal, you will receive the interest at maturity. Then there are some deposits which are called recurring deposits. For example, if a person is getting a salary and he knows that every month he has a surplus of 5,000. So what he can do is, rather than doing deposits every month, for the surplus he has to go to the bank every time and make deposits 5,000 each. So rather than that, what he can do is, he can do a recurring deposit. He can make an application like, I want to make a recurring deposit 5,000 rupees per month for the next 12 months, and I will take the money after 1 year. In this case, each month 5,000 will be transferred from savings bank to recurring deposit. At the end of 1 year, 60,000 plus interest will be credited to the savings account. So these are called recurring deposits. So in all three these type of deposits, you have a fixed maturity date. That's why these are called time deposits. Now technology has improved. Whatever I said, example like going to the bank, doing that, you can do it yourself online through internet banking. But for explanation purposes, I am telling that you go to the bank, you make deposits, you receive the deposit receipt and all. So usually interest rate for these deposits will be 5 to 6%. So that is the range nowadays. It is there. Maybe few deposits less than this interest, maybe few deposits above this interest, but usually it is around 5 to 6% depending on the tenure of the deposit, whether it is for 3 months, whether it is for 5 years, 1 year, 2 year. For each of the time period, the interest rate will change. Similarly, for the amount of deposits also, it will change. Deposits above 1 crore, below 1 crore, like that also they have slabs. Based on that, interest rates will change. So primary thing is that it is as a fixed maturity period. That's why they are called time deposits. But if you are in an urgency, if you are in an emergency, can you close the time deposits before their maturity date? Yes, that option is available. But it is not like a demand deposit. You cannot withdraw several times, redeposit several times. Only once you can deposit and only once you can withdraw. And usually after the maturity time. That's why it is called time deposits. So usually savings bank account are opened by individuals and current accounts are opened by businesses. So now we'll move on to what are the different types of banks. So we have primarily scheduled commercial banks and scheduled cooperative banks. What is a scheduled commercial bank? Reserve Bank of India schedules some commercial banks which are mentioned in the schedule to the Banking Regulation Act. So if a bank's name is found in that particular schedule, they are called scheduled commercial banks. And there are another type of banks called scheduled cooperative banks. You see a lot of cooperative banks and some of them are governed by the Reserve Bank of India. They are called scheduled cooperative banks. If the name is found in the list, then it is called scheduled cooperative banks. But whatever we study in this particular lesson, we focus only on scheduled commercial banks and we are not going to study anything about scheduled cooperative banks. So what kind of businesses a banking company do? It's mainly governed by the objectives clause of the banking company and it is elaborate. It will be listing so many items. A bank can do a lot of items. Primarily they will be doing deposits. After that, they will do lending. Again, in lending, you can say what is a long-term lending and what is a short-term lending and what is a demand loans, term loans and demand loans again. And they can do investment also. So what type of loans you know? Some of the loans are housing loans. If you want to purchase a house or construct a house, you can take a housing loan. Similarly, if you want to purchase a vehicle, you can take a vehicle loan. If you have some gold ornaments and suddenly you have some personal emergency, you can pledge the gold and take the gold loan. And for business purposes, working capital management, there are two types of demand loans, cash credit and overdraft. These are demand loans. Like a demand deposit, these demand loans, cash credit and overdraft, in this case, the bank says you can withdraw up to a maximum of, let's say, 10 lakhs. So if you want, you can take it. Otherwise, if you want only 50,000, you can take it anytime you want. Usually, these limits are sanctioned for 1 year time. So you can withdraw 50,000 any day. Up to 10 lakhs, you can withdraw any amount any day. At the same time, you can repay that also any day, any amount any day. So these are called demand loans, cash credit and overdraft. These are primarily provided to the businesses to take care of their working capital management. Then term loans. These term loans cannot take any time and repay anytime. For example, housing loan, if you are taking, usually it is for a longer period, like 240 EMIs. EMI means equated monthly installment, 240 installment, 180 installment. Usually housing loan is for huge amount, so you cannot repay very quickly. A minimum of 10 years it takes. Around 15 to 20 years is the normal tenure people are taking housing loans. So once you take, let's say, 10 lakhs housing loan, every month you will have to pay 10,000 for next 10 years, 12 years, 15 years, like that. So the amount will be given only once and the repayment happens over a period of time. You can prepay, but generally it takes over a period of time. Similarly, vehicle loan, when you buy vehicle, at the time the loan is given, you have to repay over a period of time. Gold loans generally given for a period of 1 year. After 1 year, you have to repay the loan. This gold loan also given only once. But in this cash credit and overdraft, what happens is they simply give a limit. Within that limit, you can withdraw money and you can deposit money at any time. So these are the primary form of lending. We will study detailed in further pages, but as for now, this is okay. This much understanding is okay. Basically, we should know that there is a lending. It can be demand loans or term loans. Then investing, and they invest in government securities. Even recently, you would have seen that government has presented a budget. What is the amount of budget? The amount of budget was around 30 lakh crores. In the 30 lakh crores, how the government is getting money? They are getting various taxes like corporate tax, income tax, GST, and so on. But still, they get only around 20 lakh crores. So what happens to another 10 lakh crore? Because government's expenditure is around 30 lakh crores, but income is only 20 lakh crores. 10 lakh crores they borrow. From whom they borrow? From the individuals, it's very difficult. So generally, they borrow from the banks. They issue government securities, and based on that, they get money from the banks. So almost every year, they borrow around 10 lakh crores. So this year, they are planning around 10 lakh crores. So this will be from the banks they will be getting. Banks receive money from the public and give it to the government. So, and what are the various functions of commercial bank? Primarily accepting deposits, then dealing in securities, and then lending. Apart from accepting, dealing in securities and lending, they do money transfer also. What is a money transfer? If you want to transfer money from one account to another account, it's a money transfer. If you want to pay your income tax, what do? You debit your account and the credit goes to the government. If you want to pay some supplier, what happens? The money is debited here and paid to the supplier. Likewise, some students are studying in abroad. Then what happens? Their parents send money from here to abroad. All these are called money transfer. Then issuing of LC and guarantees, that we will study further later. And safe custody. What's a safe custody? Usually if you see a bank, there will be a security guard and there will be a strong room. What is a strong room? It is specifically constructed for the purpose of safekeeping. The walls will be very strong. They will be having some grill, iron grill also. So usually it is more safer than a house. So what people do is, within that they'll be having safety lockers which have double lock, and one key will be with the bank official, one key will be with the locker holder. If both of them open at the same time, then only the locker will open. It is highly secured. So many people, rather than keeping their home, they will keep their jewels and even other valuable documents inside the safety locker. So the bank will charge certain amount of rent from the locker holder. So this is called safe custody. And then executors and trustees, they can function as executors and trustees. Then what a bank cannot do? A bank cannot do trading activities. What is a trading activities? Buying and selling. A bank cannot do anything like buying and selling of any sort of thing. Then we will move on to a concept called reserve funds. It's a very, very important concept. You should always remember. You should never forget. What is reserve funds? Banks have to create reserve fund and transfer 20% of its profit to reserve fund every year. It's a kind of a reserve which will be part of the schedule called reserves and surplus. In that schedule, what you should have, you should create a reserve fund. If the profit for a bank in a particular year, let's say it is 200 crores, then what you need to do, you have to transfer 40 crores mandatorily to this reserve fund. Balance 160 crores only you can do appropriation. You can declare dividend or you can do whatever. But a minimum of 20% you should transfer to the reserve fund every year. So even in examination problems, they may not ask you specifically to transfer amount to the reserve fund. But if you are preparing the profit and loss account of a bank, even in examination situation, even if the question is silent, you have to mandatorily transfer 20% to the reserve funds, because they'll be expecting you to know this and do this adjustment. There'll be a mark to this. If you are not doing that, thinking that it is the question is silent, they did not ask us to transfer 20% to the reserve fund, then you will be losing on the marks. So it's a very, very important concept. Always remember to transfer 20% of the net profit for the year to the reserve fund. Then payment of dividend. There are restrictions. Banks to satisfy the requirements as per the Banking Regulation Act. The board of directors don't have the full freedom as to payment of dividends. There are a lot of requirements as per the Banking Regulation Act. They have to fulfill all those requirements. Then only they'll be able to make payment of dividend. So only a theory portion you can study from the study material. What are the various requirements? A remote chance of this question coming in the exam, And for practical questions, this doesn't have any relevance. But for your knowledge purpose, please study and understand what are the various requirements. Then we will move on to another very important concept, which is a cash reserve ratio. What is a cash reserve ratio? All the banks should maintain a cash reserve ratio of 3% on NDTL. So what is a cash reserve ratio? That we will see. A cash reserve ratio is a particular ratio. How you arrive at this particular ratio? What you have to do is you have to take the NDTL and you have to take the cash reserve. What is a cash reserve? It is either the reserve with the bank itself or a balance in current account with RBI. This is called cash reserve. So what a bank should do is a certain portion of it is NDTL, net demand and time liabilities. We have seen that demand and time liabilities. What is a demand liability? A demand liability is a demand deposit. So we have seen that savings bank and current accounts are called demand deposits. In other words, we can call this as demand liabilities because deposits are liability of a bank. Similarly, term liabilities. What are the term liabilities? Fixed deposit, cumulative deposit, recurring deposit. All these are called time deposits, as well as we can call them time liabilities. So you should total them. NDTL is net demand and time liabilities. For example, if the demand liability is 100 and term liability is 200, our NDTL will be 300. This is called NDTL, net demand and time liabilities. Out of this, we have to maintain cash reserve ratio of 3%. It means if our NDTL is 300, we should maintain at least 9. If it is 300 crores, we should maintain 9 crores in the form of cash reserve. What is a cash reserve? Cash reserve is that if we have a cash in bank, we have to specifically apportion certain portion as a reserve. We should never use it on a day-to-day basis. We should keep it away and call them as a cash reserve. Or the bank should deposit this amount with the Reserve Bank of India in current account. Like businesses have current account with banks, banks will have current account with RBI. Because whenever you study about RBI in banking theory, you have studied that RBI is bankers' bank. We have our banks. RBI is the bankers' bank. So whatever surplus money banks have, they will deposit with RBI. If they want loan, they can take it from the RBI. Similarly, they will have current accounts with RBI. So this balance current account with RBI can be used for the cash reserve ratio. Then we'll move on to licensing of banking companies. If anybody wants to open a company, they can do it very easily. We have to see the Registrar of Companies website, name availability. If name is available, then we can create our memorandum of association and we can register the company and we can get the registration. But to start a banking company, it is not easy. You cannot simply register with ROC and start a banking company. Here you have to satisfy the terms and conditions put forth by the Reserve Bank of India, and they have a very stringent requirements. What are the very stringent requirements? It is that you should have a initial amount of 500 crores. If you have 500 crores only, then only you can start a banking company. If you have a lesser amount, you cannot start. Even if you have 500 crores, you cannot easily open a banking company. So minimum, the licensing is very stringent by RBI. Applicant to satisfy minimum capital requirement. At present, they say you should have a minimum capital of 500 crores. Then only you can start a bank, and they should have a excellent track record. The company which is applying for banking license, that business group and the promoters should have an excellent track record. They should not have any criminal background. They should not have any fraudulent background. All this the RBI will be checking. So then only they will allow a particular promoters to start a banking company. Then we'll move on to the liquidity norms. In the liquidity norms, we'll study about a concept called statutory liquidity ratio. The statutory liquidity ratio should be 18% of NDTL. Now we know what is NDTL. It's a sum total of net demand and time liabilities. Out of the NDTL, you should have at least 18% in the form of statutory liquidity ratio. So SLR is in the form of either cash, gold, or unencumbered approved securities. So banks should have a minimum 18% of their deposits in the form of either cash or gold. If you keep cash, what happens? There is no appreciation. You will not get any returns. So very, very small portion only you can keep it as cash. Then sometimes they will retain gold. Gold, there will be a price appreciation, but you will never know how much it will appreciate and when it will appreciate. Sometimes there is a risk that the prices of gold will come down also. So it's also risky. So primarily this SLR will be maintained in the form of approved securities. The Reserve Bank of India has a list of securities in which the banks can invest money. Those are called approved securities. Sometimes what happens, the banks, when they are in need of money, they pledge these securities with the Reserve Bank of India. Then they are called encumbered securities. Approved securities, but encumbered. Why encumbered? They are given as a security to Reserve Bank of India for taking loans. So those type of securities are also not eligible to be part of SLR. Then what is eligible? Unencumbered approved securities. Securities should be there. It should be approved, as well as they should not be given as a security to anybody. So this is called unencumbered approved securities. So these three form of the SLR, and the percentage of SLR at present is 18%. Every month there will be a Reserve Bank of India thing will be there. At that time they will decide what should be the percentage. They don't change it every month, but at least they review on a monthly basis. So at present, CRR, cash reserve ratio, is 3% and statutory liquidity ratio, SLR, is 18%. But this is subject to change, called monetary policy. These are tools of monetary policy which the Reserve Bank of India uses. Reserve Bank of India has the mandate to monitor the economy, especially money related issues of a country. So how much money is flowing, what is the interest rates, what is the supply of money, everything should be monitored by the Reserve Bank of India. And not only monitoring, they have to regulate also. In order to regulate, they have some monetary tools. And the monetary tools, couple of them are called, one is cash reserve ratio, another is statutory liquidity ratio. By increasing this or decreasing this, they can regulate the money flow in a country. For example, cash reserve ratio is just 3%. This means this is one of the lowest percentage now. So the banks will give loan to the public. If the Reserve Bank thinks that the bank should not give more loan to the public, they can increase this cash reserve ratio. Then more money banks have to keep with Reserve Bank of India, then less money will be available for giving loans. Similarly, in SLR also, if the Reserve Bank increases this percentage, then the banks have to keep either in the form of cash, gold or securities. They cannot give so much of loans. At the same time, if the Reserve Bank thinks that more loans should be given, they will reduce this CRR and SLR. Then more loans will be given, the interest rates will come down. Then restriction on loans and advances. No loans to directors and the specified related parties of the directors. What is a related party? Usually related party is a spouse, children and specified relatives. And as well as if the director is a proprietor of a business, if he is a partner of a business, if he is a director or is a shareholder, then he'll be, all these parties will be called as related parties. The bank should not give any loans to the related parties to the debtors. And unclaimed deposits. Sometimes what happens is the depositor makes a deposit, but he doesn't come back to take his money. Then what happens? The bank has to wait for 10 years. If in any account there is no transaction, the depositor has not taken the deposit for 10 years, then it should be transferred to the Depositor Education and Awareness Fund. Banks cannot keep those money with them. They have to transfer these to Depositor Education and Awareness Fund. Then what is the format of accounts? The format of accounts are given in the third schedule to the Banking Regulation Act, and the balance sheet should follow the Form A, which is prescribed in the Schedule 3. And profit loss account should be prepared as per the format given in the Form B of to the third schedule to the Banking Regulation Act. These things we will study in detail later. And then we will move on to the accounting system. So in the study material, you have a unit called accounting system in bank, but it is more of a manual system which existed previously. Now it is not there because all the banks now are computerized and they use something called core banking system or CBS. But in the study material, they are explaining the process flow as per manual thing. There is no harm in studying that, and in CBS it is little difficult to explain. In manual you will understand them easily, and you cannot expect any theoretical questions from this accounting system of bank. This is only purely to improve your knowledge about how the accounting system works in bank, so you can study from the study material. But what is more relevant and current is CBS, core banking system. That's also part of your intermediate syllabus, so you focus more on that because it is interlinked with banking. So I will talk briefly on the classical style of banking. What is a classical? What happened some 30 years ago, 40 years ago? This is happening still, but now, but earlier this was the only way the bank was working. But now there are so many advancements in the bank. So earlier they had slip system of accounting. Still this is working. What is a slip system of accounting? Any withdrawal is by any deposits, it is done by pay in slip. If you want to deposit money, what you have to do is you have to go to the bank and you have to fill up a slip which is called pay in slip. they will have two parts to it. The left hand side, a small part will be there, which will be a acknowledgement to you. On the right hand side, there will be a much bigger slip where you have to write the date, the bank branch, and it will be a pre-printed slip. It will have a bank name and so many other details. Even branch name, they will put a seal. So what do you have to write? The date on which you are depositing. Then what do you have to do? You have to write the depositor's name, and means the account holder in which account you are going to deposit. So account holder's name you have to write, and the account number you have to write. After that, you have to write how much money you are depositing. If you are paying cash, then you have to write the denomination, means how many 500 rupees notes you have, how many 2000 rupees notes you have. Each of the denomination you have to fill it up, and you have to write the total, and you have to sign the pay-in slip, and you have to fill up the counterfoil also. What the bank cashier will do, he will put a seal on the pay-in slip, and one part he will give you, one part he will have it for his accounting purpose and documentation purpose. That's how the money will be deposited into the account. Sometimes you can deposit checks or DD, demand drafts. You have to fill up the details regarding the demand draft or check. What is the number, which bank has issued it, and what is the amount. All those things you have to write it. So they will send it for collection, and they will credit to your account. So for the purpose of deposits, we use a slip called pay-in slip. Then withdrawal. If you want to take money from your account, withdraw money, what do? You have to use either checks or withdrawal slips. In earlier days, most people used to use the withdrawal slip, because some of the accounts, they don't even issue checkbooks. If they have issued checkbook, you can fill up the check and take the money. You have to fill up the check saying what is the date, to whom it has to be paid. If you are withdrawing yourself, you have to write self, and you have to fill up the amount in numbers and words, and you have to sign the check. Whatever specimen signature you have given while account opening, that signature you have to sign. Then you can withdraw money by issuing checks. But if you don't have check, then you can fill up a slip called withdrawal slip, which will be available in the bank branch. You can fill up the withdrawal slip, and you can withdraw the money. And what happens is, the bank officials will have a lot of work. They will have to write some credit vouchers, some debit vouchers. They will have to, for example, for savings and bank accounts, they have to credit the interest. What they will do, they will debit the interest account and credit the SB account. For these purposes, they have to pass some credit slips and debit slips. Together, these are called dockets. These are done by the bank officials, not the customers of the bank. Only the bank officials do this. So these are called dockets. So this is the classical system of banking, which is a slip system of accounting. For debit and credit, you have separate slips. And even for a journal entry, we have do it. If you have a physical cash, but you don't want to go to the bank branch and give it to the cashier, how you will deposit? ATM. In some banks, they call it cash deposit machine, CDM. Some banks, they say cash recycler or whatever the name it is. Then in some of the ATMs, deposit machines are there, which can accept money. You can put the account number, then a particular thing will open. In that slot, you keep the cash, it will take it, count it, and credit to the particular account. If you have physical cash, you can do that. If you don't have physical cash, and there are n number of ways you have, you can transfer it through net banking. You can transfer it through mobile banking. So you are also becoming an accountant in bank. You have an account and another person has an account. You can transfer it. NEFT is there, RTGS is there, and IMPS is there. So many methods of payment are there. So NEFT is a National Electronic Fund Transfer. What happens is, if the amount is smaller, let's say below 2 lakhs, then you can transfer it through NEFT. All these NEFT requests are aggregated at Reserve Bank of India. Then every 1 hour, the amounts will be transferred to the respective accounts. Then there is an RTGS, real-time gross settlement. If the amount is more than 2 lakhs, RTGS you can do. In RTGS, what happens? It gets credited immediately. And again, immediate transfer payment is there. IMPS, I forgot the abbreviation. IMPS also, you will get the transfers immediately. As soon as you transfer, it will be credited to the receiver's account. So all these technological developments are there. Similarly, checks, withdrawal slips. You can go to the ATM and withdraw physical cash. If you simply want to transfer to other persons, you can do it through either ATMs also it is possible, or from the mobile banking and internet banking, you can do it yourself. But the bank officials, they use the credit slips and debit slips as a part of documentation and accounting vouchers. They still do that, even though it is done in the CBS. You should have the supporting vouchers, no? So they still prepare this. But earlier there used to be manual ledgers where they used to write. They used to maintain a lot of manual ledgers, a lot of manual registers. Now most of them are computerized and in the part they are in the form of a core banking system, CBS. CBS is completed for you guys or not yet completed? CBS portion already completed earlier. Not part of advanced accounting, as part of IT. I think it would have been completed by now. Completed. Okay. Thank you. So you already know that what is a CBS and what are the various functions of CBS and how it works. Okay. So with that, we have completed the first 2 units in the study material. If you read the study material, it will be covering so many pages will be there. Not everything is relevant. All those things are just to improve your knowledge. They are required but not relevant from examination point of view or problem solving point of view. So I have given the gist of all these important points. So this is sufficient. These things you must understand and must remember, and you can go through the study material for the detailed explanation and the theory part. So now we will move on to the capital adequacy ratio, which is a three.
Sure.
I think we have covered quite a lot of concepts now. So we'll take some 10 minutes break and we'll continue our lessons after 10 minutes. If there are anything, any questions or anything, you just you can ask after the break. If you don't have any questions or doubts, we'll proceed with the next unit, unit 3. So we'll take some 10 minutes break. See you. Hope you guys have joined after the break. So shall we proceed now?
Yes, sir.
Okay. Any doubts so far? Because we have covered quite a lot of concepts in a short time, because these are covered as part of two different units in your study material. So any doubts, any questions, even general questions, if you have anything about banking, you can ask me. We can discuss. Because now we'll proceed to practical problems. Okay, since nobody has any doubt, so I will proceed to the unit number 3, which is capital adequacy norms. So we should know the background about capital adequacy norms. Any type of company will have capital. So what is the purpose of capital? That is the basic minimum amount you are starting a company. But once you start the company, you can get loans from the banks. You can raise money through debentures. You can raise money from the capital markets and so on. But if there is any losses, who will bear the losses? The losses will not be borne by the creditors. The losses will not be borne by the debenture holders. Then ultimately, who will bear the loss? The loss will be of the shareholders. So, capital is the buffer. If there are any losses, it will be absorbed by the capital. So, in order to ensure that the banking companies does not collapse, even if there are losses, then they have to maintain a minimum capital. These minimum capital requirements are part of the Basel norms. Now, as you know, the economy is globalized. In one country, whatever happens, like any problem in the United States of America, if they have a financial problem, what happens is it affects the whole of the world. In India also we have share markets, we have banks, we have the foreign currency, imports, exports. So all these are getting affected. For example, in 2007, 8, I think in 2008 there was a financial crisis which happened in the United States of America. So it is a purely a problem in one particular country. What happened is interest rates have increased suddenly. Because of that, lot of borrowers have not repaid the money. Because of that, one financial institution called Lehman Brothers collapsed. But it's a multi-trillion dollar company. So when such a huge financial institution failed, it triggered the collapse of all other financial institutions in the United States. But the companies in United States have presence across the world. Because of that, all the countries' financial systems got collapsed. So the government had to help them. Otherwise, the deposits will be collapsing. Then share markets started collapsing. Many people have pledged their shares for taking loans. So what happens? All those loans, they become uh, default. So the across the world, share markets collapsed and financial markets collapsed. Money was very hard to come by. Nobody was willing to give any loan, and lot of insurance companies invest in share markets. So insurance companies started failing. Like that, if the failure was not arrested, it will be called a domino effect. On insurance companies will fail, banks will fail, all the companies will fail, the economy will fail. So such a bad situation was about to arise. So all the governments provided unlimited amount of capital to the banks, so that the banks keep running. Otherwise, what will happen? The entire economy will collapse. So after that, what they have done is they have provided them some safety framework. They have understood that one bank should not trigger the economic collapse of one country. One country's economic collapse should not trigger the entire global financial system meltdown. So what they have done is they have formed a Basel norms. Reserve Bank of India is also part of this Basel framework, which is an international framework. That international organization will specify certain norms which should be followed by the member countries. Then in member countries, their regulators have to have these norms adjusted for their local conditions. So based on this Basel norms, Government of India has approved Reserve Bank of India as a regulator. So for banks, Reserve Bank of India says that banks should be sufficiently capitalized. This capitalization is called as capital adequacy ratio or CAR. What is this capital adequacy ratio? If you divide your capital fund by risk weighted assets plus off balance sheet items, it should have a minimum of 9%. So what is capital fund? Capital fund is tier 1 capital and tier 2 capital. These two components together, they form the capital fund. So this tier 1 capital should be 7% and tier 2 capital should be a minimum of 2%. So our banks should have a capital adequacy ratio of 9% at all times. So in every quarterly interval, Reserve Bank of India will be checking the financial statements of banks and they will see how much capital adequacy banks are having. Even though 9% is the minimum required, the Reserve Bank of India will encourage that banks should have more capital. If in a particular year the banks have made loss, what happens? It will be deducted from their capital. So if it falls below 9%, Reserve Bank of India will say that you stop your operations. They will say prompt corrective action, PCA. Those banks will come under PCA. Then Reserve Bank will be closely monitoring them. They will not allow them to give more loans and they will ask them to raise more capital so that there is a minimum of 9% capital. So that is the concept and that is the reason why these norms have come. So now we'll see the practical problems, how to work out practical problems. For that, you should know a few things. First is, what is a capital fund? Capital fund is sum total of tier 1 capital and tier 2 capital. So now we have to see what is the concept of tier 1 capital. In the case of Indian banks, means banks incorporated in India. Excuse. Tier 1 capital includes 1. Paid up capital, then disclosed free reserves and statutory reserve and share premium. And second, perpetual non-cumulative preference shares or in short PNCPS, and it should be approved by Reserve Bank of India. And 3. Innovative perpetual debt instruments, IPDI, again approved by RBI. And then 4. Capital reserves representing surplus arising out of sale of assets. These are part of the tier 1 capital. You know what is a paid up capital? What is a paid up capital? As part of our share capital, whatever we have issued and subscribed and then paid up is called paid up capital. Then free reserves. Reserves which are free for distribution as dividend, they are called the free reserves. And then statutory reserve. Just now we have studied, while studying the concept, there is a statutory reserve all the banks have to maintain. This reserve fund is also called a statutory reserve. All the banks should transfer 20% of their profit in each year. This is called a statutory reserve or reserve fund. This is also part of the Tier 1 capital, as well as share premium. Whenever we issue shares at a premium, we separately account it as a share premium or securities premium. That is also part of Tier 1 capital. Then some new concepts. Perpetual non-cumulative preference shares. You would have studied about preference shares. What is the difference between ordinary equity shares and preference shares? In the case of preference shares, they will be having a specified percentage as dividend. In preference shares means they will carry a specified percentage. Ordinary shares, they are not entitled for any specified percentage of dividends. But in preference shares, they have a, let's say 10%, 20% like that, it will be said. Then preference shares carry a specific percentage of dividends, and they have a preferential rights. If profits are insufficient, first we will pay the preference dividend, then only we will have ordinary share dividend. And in this again they have couple of more features. One is perpetual. What is perpetual? A preference share can be redeemable or perpetual. If a preference share is redeemable, then of let's say 10 years, the preference shares will be redeemed after 10 years. The amount will be repaid and the shares will be redeemed. If it is for a particular tenure, these are called redeemable. If it is not redeemable, then it is called perpetual. So it will continue forever. We will never take those preference shares back and pay the money. Then cumulative and non-cumulative is another feature in preference shares. Cumulative means in the case of preference share dividend not paid in one particular year. Let's say preference share carry a dividend of 10%. In one particular year there is a loss. Then what happens? Preference share dividend will not be paid for the year. In the case of cumulative, it will be paid in the future. Whenever there is sufficient profits, all those preference share dividends which were not paid earlier have to be paid. That is called a cumulative feature. If this feature is not there, it is called non-cumulative. In a particular year, profit is there, dividend will be paid. If profit is not there, preference dividend will not be paid. Such a thing is called non-cumulative. So, for a preference share to be eligible to become a Tier 1 capital, you should have these two features. One is perpetual and second is non-cumulative. And there are some innovative perpetual debt instruments which are approved by RBI. If there are anything is there, then it should be part of the Tier 1 capital. Then capital reserves. Suppose we have sold some of the assets of the bank, then whatever profits, that is called a surplus, it will be separately kept as a capital reserve. In the case of a bank, such capital reserves are eligible to be Tier 1 capital. From the sum total of these four items, then we have to reduce two things. What are they? One is intangible assets. If there are any intangible assets in the bank and any losses, current period and brought forward losses are there, we have to reduce it from the sum total of these four items. And if there are any deferred tax assets, there also should be reduced from the Tier 1 capital. Then it is called a Tier 1 capital. Then we'll move on to the Tier 2 capital. What are the components of Tier 2 capital? If there are any undisclosed reserves, but in the case of banks, these undisclosed reserves are not possible because these are listed companies as well as they are audited by chartered accountants. So in this case, there cannot be undisclosed reserves. But if there are any undisclosed reserves, they are also part of the Tier 2 capital. Then cumulative perpetual preference shares. So these cases, this is a preference share as a perpetual feature, but doesn't have a non-cumulative feature. So this is a cumulative perpetual preference share. They are also part of the tier 2 capital. Then revaluation reserve at a discount of 55%. What is a revaluation reserve? There are many assets a bank carries. Sometimes they would have appreciated in value. For example, if you take a State Bank of India, it was established more than 100 years ago. So at that time, they might have purchased their land. Let's say some 10 acres of land purchased for 10 lakhs. It is possible in olden days, the prices will be much cheaper. So they have 10 lakhs as the value, but now 100 years have gone by, and that same land price will be around 100 crores today. So since it is kept as a historical price, in our balance sheet we will show the land at historical cost price. We will always be showing at 10 lakhs, but if you do the revaluation at market price, they are worth 100 crores. So what you can do, if you want to show the assets at the market price, you can increase from 10 lakhs to 100 crores. So land value will be shown at 100 crores. Then how much is the profit? The profit is 99 crore 90 lakhs. So this will be called as a revaluation reserve. So if there are any revaluation reserves like this, then what we need to do is we have to discount it by 55%. For example, 100 lakhs is the revaluation reserve. Then there should be a discount of 55 lakhs. So what will be the net amount? The net amount will be discount will be 55 lakhs. Net amount will be 45 lakhs. So you have to value this at 45 lakhs revaluation reserve. Then hybrid debt capital instruments approved by RBI. There are some type of hybrid debt instruments which are approved by RBI to be part of tier 2 capital. What are they? They can be either perpetual cumulative preference shares or redeemable but non-cumulative preference shares, or it can be a redeemable cumulative preference shares. All these type are called hybrid debt capital instruments. If they are approved by RBI, they will be part of the tier 2 capital. So you can see there are two different features. One is cumulative, non-cumulative. Another is perpetual and redeemable. If it is it's perpetual as well as non-cumulative, then they are eligible to be part of tier 1. If you see, it is both perpetual as well as non-cumulative. If this non-cumulative feature is not there, it's cumulative, then it will be part of the tier 2 capital. If it is not perpetual, then also it will be part of the tier 2 capital. You can see here, it is perpetual but not non-cumulative. So they are part of the tier 2 capital. In this case, it is not perpetual. It is non-cumulative, but it is not perpetual. Again, part of tier 2 capital. Here in this case, it is cumulative and redeemable. So both features are not there. So part of the tier 2 capital. Then subordinated debt. So initial maturity greater than 5 years and residual maturity more than 1 year. Any kind of securities which are subordinated and this kind of features are there, they will be part of the tier 2 capital. Then foreign currency translation reserve. If anything is there, then they are taken at a discount of 25%. It is one of the specific reserve carried by the banks, foreign currency translation reserve. why they carry this foreign currency translation reserve is that some of the banks will have foreign branches. If you have a foreign branches, when you are consolidating your accounts, what you should do, you have an Indian balance sheet, you have a balance sheet for the foreign subsidiary, but the reporting should be in Indian rupees. Then what you do, the balances in the foreign subsidiaries balance sheet, you multiply with the foreign exchange prevailing on the closing date. So then there will be a foreign currency translation. So for this purpose, for tier 2 capital, it is eligible, but you have to discount it by 20%, 25%. Then if there are any general provisions, loss reserves, investment reserve, general provision on standard assets, provision for country exposure, all these will be taken together, but they cannot exceed 1.25% of the risk weighted assets. What is risk weighted assets? We will discuss later. But what all these type of reserves should not exceed more than 1.25% of risk weighted assets. What is the investment reserve? We will study little later. And what is a general provision on standard assets? That also we will study little later. And provision for country exposure. As I told you, many banks will have foreign subsidiaries. At the time, what they have to do, sometimes they have to keep a particular provision for country exposure, for a specific country's exposure. If there are any provisions are there, it is eligible to be part of the tier 2 capital. So many concepts are new for you. So what you have to do is you have to memorize all these concepts. Then only you will be able to complete a sum based on CAR, capital adequacy ratio. It is thrice, then you will be able to memorize this. So familiarity is required. You have to read many times. Then deductions from tier 1 and tier 2 capital. From the sum total of this one, tier 1 capital, and this is the sum total of tier 2 capital. You have to add them together, and still you have to make further adjustments. Sorry. Yes. Yes, சொல்லுங்க. Somebody is asking questions. Who is that? What is that question? So what are the deductions? 1. Equity and non-equity investment in subsidiaries. If the banks have invested in subsidiaries, you have to remove that investments from the sum total of tier 1 and tier 2 capital. Then credit enhancement pertaining to securitization of standard assets. If there are any credit enhancements from such an amount, 50% should be deducted from tier 1 and 50% should be deducted from tier 2 capital. What is a credit enhancement and what is a securitization? The theory portion is there. So this is the computation in case of Indian banks. If a bank is a foreign bank, for example, in India you have a Citibank. Whether it is an Indian bank, no, it is incorporated outside India. They have a branch in India. If you have a Standard Chartered Bank, they don't have. They are not an Indian bank. HSBC Bank, they are not banks which have been incorporated in India. They are basically incorporated outside. Their parent company is elsewhere. So these type of banks are called foreign banks. For foreign banks, this capital adequacy ratio calculation will be slightly different. So for them, tier 1 capital includes interest-free funds from head office to meet CAR, capital adequacy ratio. Especially for meeting this CAR, they will get interest reserves in Indian books. And then innovative perpetual debt instruments. Then remittable surplus in Indian books. What is remittable surplus? They are doing the business in India, and of it will be 20% will be transferred to the statutory reserves. Balance will be called the remittable surplus. They can take this amount to their head office. That is called remittable surplus, which is in Indian books. All this will be part of the tier 1 capital. In the case of tier 2 capital, same elements as in the case of Indian banks. So here we have seen this 6 different items which are eligible to be tier 2 capital. These are eligible in the case of foreign banks as well. Apart from that, head office requirements. This also will be included as part of tier 2 capital. Now we'll read the next thing about risk weighted assets. What is a risk weighted assets? In the balance sheet, we'll have a list of assets. What we need to do is we have to apply a certain thing called risk weight to the asset value. Whenever we multiply asset value with risk weight, then it's called risk weighted assets. And there are some major category of assets and risk weights. I have listed down some of the major category of assets with the risk weight. So let us see what are the assets and what is the risk weight associated with that particular asset. So in the case of cash and balance with RBI, what is the risk weight? It is 0. Who decides on this risk weight? Reserve Bank of India decides on this risk weight. So for cash and bank balances with RBI, risk weight is given is 0 because there is no risk with the amount. Cash, it will not change value. Balances with RBI is the highest safety we can have. So they don't have a risk. Balance in current accounts with other banks, they carry a risk weight of 20. This is in terms of percentage. It's not a number, absolute number, it is a percentage. Risk weight is a percentage. Then investment in government securities, again risk weight is 0. Other investments, 100% risk. Loans and advances guaranteed by the government, 0. Other loans and advances, 100. Bank premises, furniture, fittings, 100. All off balance sheet items like letter of credit, letter of guarantee and bills, 100%. These are called off balance sheet items. And non-funded exposure to real estate, 150%. So these are the various type of assets. When you go through the balance sheet of the bank, you will find all these. So you have to take the asset value as per balance sheet and you have to multiply this risk weight. So you have to basically memorize all this risk weight. But what is the general logic? The logic is that if anything to do with Reserve Bank of India or Government of India, the risk weight will be 0. If it is something to do with the other banks, then the risk weight will be 20%. If it is generally, it will be 100%. Anything, if you have a asset item which has nothing to do with Reserve Bank of India or Government of India or other banks, then it will be 100%. So you can see that cash and balance with RBI. So RBI is involved, risk is 0. Then government securities, government is involved. Government of India, so risk is 0. Loans and advances guaranteed by the government, risk is 0. Then banks, other banks are involved, risk weight is 20. So otherwise, general percentage is 100. One exception is non-funded exposure to real estate. This particular off-balance sheet item carries a risk weight of 150%. So now from this particular equation, which is capital adequacy ratio, we have studied what is a capital fund. Capital fund is a sum total of tier 1 capital and tier 2 capital. And what is tier 1 capital? It has various components. What is tier 2 capital? Again, it has various components. And together, there are some adjustments to be done. So, all this net total will be called the capital fund. So, if you divide the capital fund by risk weighted assets plus off balance sheet items, then we get the capital adequacy ratio. So now we have discussed what is a risk weighted asset. Basically, risk weighted assets is value of assets as given in the balance sheet multiplied by the risk weight which is suggested by the Reserve Bank of India. So this is the table which we need to use. And off balance sheet items. Also, you have to multiply the risk weights. So you will have the sum total of risk weighted assets plus off balance sheet items. If you apply this formula, we will get the percentage. And what is the minimum percentage? The overall percentage is 9% minimum is required. Above that, it can be any number. Then tier 1 capital, it should be a minimum of 7%. Tier 2 capital, it should be a minimum of 2%. How to calculate the tier 1 capital and tier 2 capital percentages? Instead of capital fund, if you apply only tier 1 capital, it will be called tier 1 capital adequacy ratio. If you divide only the tier 2 capital by risk weighted assets and off balance sheet items, it will be called tier 2 capital adequacy ratio. Totally, it will be called capital adequacy ratio. In India, at present, the banks should have a minimum CAR of 9%. In this particular theory portion, lot of new concepts will be there. What I would suggest is you have to go through the unit 3 theory in detail at least twice or thrice. Then only you will become familiar with the concepts. Otherwise, it's not very easy for anybody. Since all the concepts are new, you have to read at least twice or thrice. Then only you will become familiar. Then you'll be able to memorize this everything. So please read them at least twice or thrice. Then only you will become familiar. So once you familiarize with yourself, then you can start with the practical problems. Questions from this chapter is not very frequent. It is very rare. But still we will try to understand how to work out the practical problems. Then we'll move on to the illustration number 1. A commercial bank has the following capital funds and assets. Capital funds into tier 1 and tier 2 capital. Find out the risk adjusted asset and risk weighted asset ratio. So this is the question. For a commercial bank, they give the details. What we need to do is we have to segregate them into which components are part of the tier 1 capital and which components are part of the tier 2 capital. And we have to find out the risk adjusted asset and risk weighted asset ratio. So they have given details about capital funds. First thing is equity share capital 480 lakhs. Statutory reserve, this is comma I think. So it is 48,000 lakhs. So just omit the commas there because figures are in lakhs. It's not decimal point, it is a comma. So it is a 48,000 lakhs. Statutory reserve 28,000 lakhs. Then capital reserve 1,210 lakhs, but there is a, of which 280 lakhs were due to revaluation of assets and the balance due to sale of assets. So there are three type of capital funds. We have to segregate them into tier 1 and tier 2. After that, they are giving the assets as per the balance sheet. Cash balance with Reserve Bank of India, balance with other banks, claims on banks, other investments, and then loans and advances guaranteed by government, guaranteed by public sector undertakings of Government of India and others. Then they have premises, furniture, fixture, other assets. Then they have off balance sheet items, acceptance, endorsement, and letters of credit. So these are the various asset items they have. So what we need to do now, we have to find out what is the tier 1 capital, tier 2 capital. So now we will proceed with the solving with this practical problem. Before we proceed, just go through the all these concepts what I have told. You can go through the study material. I'll give you some 10 minutes time, then we will start with the working out the problem. So take your time and study the concepts. So hope you have gone through once. So now we will try to resolve this problem which is given here. So first what we need to do, we have to work out how much is tier 1 capital and how much is tier 2 capital. For that we should look at the various components and see what is the description with which the description is matching. So first item is an equity share capital. So the first item given in the illustration is equity share capital. So what I should do, now I have to decide whether it is tier 1 capital or tier 2 capital. I will study the definition. So paid up capital. So equity share capital falls under the category paid up capital. So it is part of the tier 1 capital. So in the tier 1 capital, I will write equity share capital, and the amount of equity share capital is 48,000 lakhs. 48,000 lakhs will be equity share capital, will be part of the tier 1 capital. Then second thing, statutory reserve. So I have to see components of tier 1 capital. It has the statutory reserve. Under point number 1, it has the statutory reserve. So I decide that this is also part of the tier 1 capital. The amount of tier 1 capital is 28,000. So statutory reserve 28,000 is classified under tier 1 capital. Then third component, capital reserve. Total is 1,210 lakhs. And what is the components? 280 lakhs were due to revaluation of assets and the balance due to sale. So totally I have 1,210, but it has two components. 280 is out of revaluation. So revaluation 280 lakhs. What is the balance? Balance is 1,220 minus 280. 930 lakhs is due to sale. So I have to see capital reserve and sale where it finds a part. So capital reserve representing surplus arising out of sale of assets. This is a point number 4 we have under concept of tier 1 capital. So they form part of the tier 1 capital. So this 930 lakhs out of sale of assets, part of tier 1 capital. So what happens to the revaluation? Again we have to go through the concept definition. Revaluation reserves are part of the tier 2 capital, and we should not take the entire amount. We have to discount them by 55%. Balance only we should take it as a part of tier 2 capital. So what I am doing is capital reserve due to revaluation is 280. Then what I should do? I should do the discounting by 55%. So 280 multiplied by 0.55, it is 154 is the discount. So what is the balance? The balance is 280 minus discount of 55%. It is 126. So my tier 1 capital is 76,930. Tier 2 capital is 126. Are there anything to be reduced? Intangible asset, losses, deferred tax assets. We have to see the assets. Do we have any intangible assets or losses? No. Claims, other investments, loans and advances of balance sheet items. I don't have anything like intangible assets or loss or deferred tax assets. So this adjustment is not required. Then I have to see deduction from tier 1 and tier 2 capital. Any equity in investment in subsidiaries. No investment subsidiaries. They simply have other investments, but no investments in subsidiaries. Then any credit enhancement pertaining to securitization of standard. There is no such words like securitization or standard assets. So this adjustment is also not required. So we can say that these are final numbers. Tier 1 capital is tier 2 capital 126, and combined adjustments are also not applicable in this particular. No securitization, nothing. So we can take the total of tier 1 and tier 2 capital, and our capital fund is 77,056 lakhs. Then now we'll move on to the next requirement of the problem. What is the second requirement of the problem? Find out the risk-weighted assets ratio. So now these are the assets as per balance sheet. What we need to do? We have to find out the risk-weighted assets. So what is a risk-weighted assets? Assets multiplied by the risk weight are called risk-weighted assets. So I have to take each asset one by one, and I have to apply with the risk weights. Then I will get the risk-weighted assets. So I'm moving on to this problem. How to find out the asset value as per balance sheet. Then I have to apply the applicable risk weight. Then I will get the risk adjusted values. So let me see the asset value. What is the first asset? Cash balance with RBI. So cash balance with RBI is 4 lakhs. So I'll write 480 lakhs. What is the second asset? Balance with other banks. Amount is 1,250 lakhs. Balance with other banks 1250 lakhs. And claim on banks. Claims on banks 2850. 2850. And then other investments. Other investments 782.50. Then loans and advances guaranteed by government. So loans and advances guaranteed by government is 128.20. 12820. Then loans and advances guaranteed by public sector undertakings of Government of India 70210. 70210. And then loans and advances others. Loans and advances others is 520250. And premises, furniture and fixtures 18200. 18200. And we have the other assets 20120. Other assets 20120. And we will move on to the off balance sheet items. How much is the off balance sheet items? Only one off balance sheet items: acceptance, endorsement, other, and letters of credit 370250. 370250. Now what we need to do? We have to multiply with the risk weight. We have to find out the risk weight. Cash balance with RBI. What is the risk weight? You have to memorize this table, and now we will check the reference. Cash and balance with RBI. Risk weight is 0. So I put a risk weight of 0 here. Balance with other banks. Balance with other banks. Risk weight is 20 percentage. Claims on banks. Again, this is banks, 20 percentage. Other investments. If you look here, it is nothing to do with the RBI or Government of India or banks. It will be around 100 percentage only. So investment in government security, other investments, it is 100 percentage. Loans and advances guaranteed by government. So loans and advances guaranteed by government, risk weight is given as 0. Loans and advances guaranteed by government, central government, public sector undertakings. Again, this will be part of government because it's a public sector undertaking, guaranteed. So ultimately it is guaranteed by the government. It is 0. Then loans and advances, others, 100 percentage. Then premises, furniture, fittings, 100 percentage. So it will be 100 percentage. And other assets. So it's not specifically given. We'll use the general percentage. It is nothing to do with the government, RBI or other banks. So other assets also will qualify for 100 percentage risk weight. And off balance sheet items. Whether it is a real estate exposure, no. It is only LCLG bills, 100 percentage. So this is the value as per balance sheet. This is the risk weight as per RBI. Now we'll get the risk adjusted values. Multiply the value as per balance sheet into risk weight. So first item, risk adjusted values 0. Second, 250. Third, 570. Fourth, 78250. Fifth, 0. Sixth, 0. And seventh, exact amount, same amount, 100%. Other assets also 100%. So the sum total. We get the sum total of risk adjusted values as 637640 lakhs. And then we have off balance sheet items. We have to multiply off balance sheet items with the risk weight. We get 370250. So I'll put it here rather. Off balance sheet item value 370250. Risk weight percentage is 100 percentage. So risk weight adjusted values 370250. So now we have to find out the CAR, capital adequacy ratio. So what is the formula? You have the capital fund divided by risk weighted assets and off balance sheet items. What is the amount of capital fund? The capital fund is 77056. And what is the risk weighted assets? Risk weighted assets is 637640. Risk adjusted off balance sheet items is 370250. So the total is 77056 divided by 100, 7890. Then we get a percentage of 7.65 percentage. So what is the interpretation there? CAR is not sufficient. They have to improve their capital adequacy ratio. Why? Because the norms is that you should have a 9% of CAR. But how much you have? You have only 7% of 7.65% of CAR. So that is the interpretation. So this is the answer. CAR for this particular problem is 7.65%. You can similarly work out CAR of Tier 1 capital, Tier 1 CAR and CAR of Tier 2. For that, what you have to do? You should have the capital fund, Tier 1 capital fund 76930, and Tier 2 capital fund, it is 126. So CAR of Tier 1 capital will be 76930 divided by this particular number, sum of RWA and OBS, it is 7.63%. Here it will be 126 divided by this amount, a very meager percentage, 0.01%. This is the CAR of Tier 1 capital, CAR of Tier 2 capital. The sum total will be 7.63 plus 0.01. Because of rounding of effect, it will become 7.65%. So what is the process? Just go through the question item by item. You classify based on the definition. So what are the things you need to do? First thing is you should be thorough with this formula and the components of the formula. You should know what is the formula for capital adequacy ratio. You should remember the Tier 1 capital and its components, Tier 2 capital and its components, and risk weighted assets. So for this you should remember the risk weights for the various assets. Once you remember all these, then resolving the problem will be much easier. You have to go through the question item by item. You should decide whether it is part of Tier 1 or Tier 2. And in the case of assets, you should multiply with the risk weights. So this is the process how we find out the capital adequacy ratio. Any questions or doubts?
No, sir.
Okay, thank you. With this, we will complete the class for today. We will have the next class, I think, on Sunday. We'll continue with the banking companies, Unit 4 and onwards. Thank you for joining.
Thank you, sir.